Hello, in this video I'll attempt to explain the expanded accounting equation to you in less than 2 minutes. Start the clock. We'll begin with the basic accounting equation. It says the stuff that a business owns is equal to the stuff that a business owes. A business owns assets. These are resources that have economic value. And it owes liabilities and equity. Liabilities are the stuff that a business owes to third parties. They represent its obligations to external creditors. And equity is the stuff that a business owes to its owners. It represents their claim on the business's net assets. In double entry bookkeeping, we treat the accounts on each side of this equation a bit differently. Assets are normal debit accounts. That means they increase when debited and decrease when credited. On the other hand, liabilities and equity are normal credit accounts. They increase when credited and decrease when debited. So there we go. Assets are equal to liabilities plus equity. This is the basic accounting equation, and it always has to balance. Now let's build this out into the expanded accounting equation. To do that, we need to take a closer look at equity. Equity is made up of two things: capital contributions and retained earnings. Capital contributions are the funds invested into a business by its owners out of their own pockets. And retained earnings are a business's accumulated profits held for future use. Let's go a step further and see what feeds into retained earnings. We have opening retained earnings plus the current year profit or loss minus current year dividends. Opening retained earnings is the balance of retained earnings at the start of the year. Current year profit is the net income generated by the business to date, and current year dividends represent the distribution of profit back to the owners of the business. Haha, but wait, there's more. How do we get to current year profit? We take the revenue that a business earned over the current year, and we deduct the expenses that it incurred. We've reached the expanded accounting equation. But hold up, what can we learn from this? First of all, we can see the link between two of the main financial statements, the balance sheet and the income statement. We can find the balance sheet on the top line of the expanded accounting equation. It's a snapshot of a business's assets, liabilities, and equity at a point in time. And we can find the income statement down here. It's a summary of a business's revenues and expenses over a period of time. With the expanded accounting equation, we can also spot the 6 main types of account in accounting: assets, liabilities, equity, dividends, revenue, and expenses. Assets, dividends, and expenses are all normal debit accounts. They increase when debited and decrease when credited. Assets are normal debit accounts because they represent the stuff that a business owns, whereas dividends and expenses decrease the stuff that a business owes. On the other hand, liabilities, equity, and revenue are all normal credit accounts. They increase when credited and decrease when debited. They're normal credit accounts because an increase in any of them increases the stuff that a business owes. Liabilities are owed to third parties, whereas equity and revenue, which is a component of equity, is owed back to the owners of the business. That, my friend, is the expanded accounting equation. Feel free to pause this video and note this down, or if you're short on time, then you can find it on my cheat sheet right here. If you want to learn more about accounting, then I do recommend watching this video next. I'll see you there.